Hey guys, welcome back to the channel. If you're new to the channel, what this is me documenting my investment journey, covering all things investment, real estate. So if you're into that kind of thing, just drop a like, subscribe. Today's video we're going to talk about negative interest rates. It's an idea that the banks have in place, in their arsenal basically, that they could put forward into use. We're going to talk about how that affects you to see where it's the best options for your money at the moment. A couple of videos chucked in here and there, so we'll just get into it. So yeah, in the news at the moment, as you see, there's interest rates could go negative before the end of the year. So what this means basically is everybody's like saving at the moment because everybody's in panic mode. So everybody's just saving. So there's not good for the economy. So what their plans is if they put it to negative interest rates, that'll mean people will start spending because there's no point having the money in the bank if it's going to cost you to sit there. So people will take their money out. In theory, that's what it's supposed to mean. But mainly they're doing it, it's not just for people like me and you, it's more for the bigger businesses, because if they have millions of pounds sitting in the bank with negative interest rate, it means a hell of a lot of difference to them. So the thing is, they'll use that money to make refurbishments, they'll push forward, so they'll use that money to invest in a company rather than it just sitting in the bank. So this is the whole idea of why the banks are doing this. So here's a quick video.
Well, it is not really a surprise. I mean, the bank was expected to leave interest rates on hold. They obviously have cut them enormously since the onset of COVID-19, down to 0.1%. That's the lowest they have ever been in the bank's history, so since 1694. And they've also pumped extra money into the economy, 200 billion and then an extra 100 billion pounds into the economy through quantitative easing. It's kind of like creating money, pumping it in to try to get things moving. But they've said they're going to kind of leave things on hold for August, or at least for the next few months, one presumes. This is their latest opportunity to look at the state of the economy. Obviously, there is no controversy now that we are in deep recession. The numbers are suggesting that. The big question is whether that recovery is going to be quite as fast as many people had hoped for. And on that front, I mean, the news from the bank, I wouldn't say it's necessarily altogether encouraging, in that, you know, we are still deep in a recession, and looking at their numbers, they're still talking about unemployment going up to very high levels, over 7% unemployment, GDP taking quite a while to recover. But at first glance, Neil, and you know, it takes a while to kind of dig into these numbers, and we'll do that over the course of the day, but at first glance, these don't look to be quite as gloomy prospects for the economy as we're seeing from other forecasts.
So yeah, that's where we are so far. I mean, the banks they're basically saying that it's in their arsenal. They are prepared to use it, not at the moment, because things are looking better. They're picking up slowly. You'll see here is the governor of the Bank of England. He'll explain in detail why he's optimistic for the future, because it does look like things are starting to ease off slowly. There are obviously cases breaking out here and there, but he is definitely thinking that the future is looking brighter than they did initially think, that they're going to go back to the levels it was pre all this. So here's the video of Andrew Bailey speaking to the BBC News about furlough, because he's optimistic about the furlough scheme ending. If you're unaware, furlough scheme here in the UK is basically the government covering people's salaries while they're not employed. It doesn't have to be paid from their employers. The government's paying their wage while they're not in work, and the scheme is due to end on October, so that's going to be a massive difference. There's going to be all these people that have been getting paid from the government but now have to be get paid from their employer, and if their employer can't pay them, so obviously they're going to be getting made redundant with no income coming in. So we'll definitely see the effects from that. So let's hear what Andrew has to say.
Rapid pickup in the economy over the last sort of two months or so. I'm not surprised about that, because in a sense, as the restrictions are lifted, you know, things do start to happen, but it's very unevenly distributed, as we know. And the fact that we've had a reasonably rapid pickup to date is very clearly, I'm afraid, not a signal that it's going to be like that going forwards. And as you can see from our forecast, we don't take that view at all. And so what I think conditions it from here onwards is obviously the continued evolution of COVID and restrictions. I think also what I might call the sort of to what degree we're seeing and will continue to see natural caution from people as they wish to sort of, in a sense, engage and re-engage with the economy more broadly. Another feature of our economy relative to some other economies is that we've got a rather larger share of sort of what I might call sort of social service, social consumption, restaurants, entertainment, etc., which of course is the most effective because it requires people to do things at close proximity.
So all in all, my takeaway is, what should you do with your money? For me personally, there's no point saving it under your bed thinking, okay, if I put it to the banks, the interest rates might go negative and then you have to start paying the bank for your money to be in the bank. In my opinion, I would say think of diversifying with your money. Put it in stocks, shares. Like here you see my Trading 212 account. This is just looking at bank. If you look at the drop off there, it's mad. It's just been going straight down. To be honest, I don't see that picking up anytime soon. Feel sorry for you if you've got any money in banks at the moment. Hopefully you're waiting for that bounce back. But yeah, I would just think about diversifying. If you've got, depends what kind of leverage you have. If you can put it in property, I would do that right now with the market. Shares, it depends. For me, like if it's just sitting in the bank with the interest rates, I would really, if it's extra money that you don't need, I would definitely try and diversify. That's the main takeaway from this. And if you're still unsure about negative interest rates, here's a quick video to explain it a bit better.
These days, we hear a lot of chatter about negative interest rates. Negative rates. Negative rates. Negative interest rates.
Get our interest rates down to 0 or less.
Countries big and small are looking for ways to fire up their sluggish economies. But when times get tough, people hoard their money. And that's not good for stimulating the economy, especially during a deep recession. Central banks have a kit full of tools to spur economic growth. Some are more unconventional than others. One of them is negative interest rates. In normal times, financial institutions park their excess reserves at the central bank. They earn interest on the cash that they keep at the central bank. But when interest rates dip to 0 or below, they are essentially paying the central bank to hold on to their money. So in theory, this encourages banks to lend money and businesses to borrow money, giving the economy the boost it needs. For customers, negative interest rates could mean a cheaper car loan, cheaper mortgage, or lower credit card fees. But will negative interest rates do the trick? Many economists can't agree. Japan, Sweden, Switzerland, and 19 countries in the European Union have used sub-zero rates. President Donald Trump argues, why can't the U.S.?
Well, I'm a believer in negative rates only if other countries that are competitors, look, Germany, they're an ally, they're friends of ours, but they're still competitors on trade and other things. So Germany, Japan, others have negative rates.
Critics say they don't work. Japan's economy has remained sluggish, even though official interest rates have been below 0 for 4 years. For banks, negative interest rates can actually make it unprofitable for them to lend money. And critics say negative interest rate punish savers for, well, doing what may seem to be the responsible thing to do. So while the jury is still out on whether negative interest rates will help boost the economy, one thing's for sure, the outlook must be pretty dire for negative interest rates to be pulled out of the Fed's playbook.
Okay guys, that's the end of the video. I know it's been kind of a mixed bag today. I just wanted to put across the point that there might be negative interest rates coming up. Anyway, for the last video, thanks to all you guys that were subscribed and all the views and stuff like that. I really appreciate it. Just trying to grow out here, grinding this channel out. Yeah, thanks for all the support. Leave a comment down below, subscribe, like, do all that good stuff. Until the next video, peace.